Here is the single most expensive mistake a beginner can make. A stock has been crashing, falling and falling, and it now looks wonderfully cheap. So they jump in to grab the bargain. And the stock keeps right on falling, slicing straight through their money. Traders have a brutal, perfect name for this. They call it catching a falling knife. Today we learn why you must never do it, and the safe way to buy a beaten-down stock instead. Let's name the temptation honestly, because it feels so smart in the moment. A stock that was $100 is now $40. Your brain screams, look how cheap. It was $100 just months ago. This is a gift. That feeling, anchoring to the old, higher price is the trap. You're not seeing a bargain. You're seeing a stock that the entire market is desperately selling, for reasons you may not even know yet. And here is the hard truth that the word cheap hides from you. Cheap can always get cheaper. A stock that has fallen 70% can still fall another 70% from there. There's no law that says a low price must bounce. A stock in genuine free fall has nothing underneath it. No floor, no support, just more room to drop. Price alone tells you nothing about where the bottom is. That is the whole meaning of the falling knife. If a real knife is falling through the air, you do not try to catch it with your bare hand. You get cut. The wise move is to let it fall, let it hit the floor, and pick it up safely once it is lying still. A falling stock is exactly the same. The danger is not the stock. It is your impatience to grab it while it is still plunging. So what is the safe method? It is beautifully simple, and it is right there in Micha's title, From Bad to Good. You do not buy the stock while it is bad, while it is still falling. You wait patiently for clear evidence that it has stopped falling and is actually turning from bad to good. You let the knife hit the ground first, and only then do you reach for it. What does the knife hitting the floor actually look like on a chart? You wait for the relentless lower lows to stop. You watch for a base to form, a stretch where the price stops crashing and goes sideways, building a bottom. Then you look for the first higher low, that early heartbeat of a term we studied before. And ideally, you wait for the price to reclaim a key level to climb back above a moving average or break above its downtrend line on rising volume. Those are the signs the knife is now resting safely on the floor. Notice the trade-off you are making, and make it on purpose. By waiting for confirmation, you will never, ever buy the exact bottom. The stock will already be up off its lows by the time you get your signal. You are deliberately giving up that perfect, impossible entry in exchange for something far more valuable, not getting cut. Missing the first 10% of a recovery is a tiny price for avoiding a 60% plunge. And here is where it gets powerful, because you can combine two of our worlds. The very best version of this is a stock that is genuinely cheap on the fundamentals, a good business that the market has oversold, and that is also now showing a confirmed technical turn on the chart. Cheap value plus a real bottoming signal is how you buy low intelligently, instead of just buying low blindly. You let the fundamentals tell you it is worth owning, and the chart tell you when it is safe to own it. But keep our steady honesty, as always. Sometimes a knife really does bounce hard right off the floor, and the disciplined waiter misses a fast, violent recovery. That will happen, and you must accept it. Waiting for confirmation is about playing the odds well over hundreds of decisions, not about being right on every single one. And of course, the long-term index investor sidesteps this entire problem because they never try to time a single bottom. They just keep buying the whole market through every decline. So burn this one into your memory. A low price is not a reason to buy. Cheap can get cheaper, and a falling stock has no floor. Do not catch the knife while it is plunging. Wait for it to hit the ground, for the lower lows to stop, a base to build, a higher low to form, and a key level to be reclaimed. Then, and only then, pick it up. That is how you turn the most expensive beginner mistake into a calm, disciplined edge. I'll see you in the next one, where we dive into Micha's own method for valuing a company. Until then, keep it simple and never, ever catch a falling knife.